I came here tonight to show you how you can create amazing wealth by investing in real estate. I came here tonight to show you how to buy your own investment real estate, but more importantly, I came here tonight to show you how to take advantage of opportunity. I came here to inspire you. The problem with most people is they'll come and they'll show you different systems and show you things, and you'll get excited, you'll walk away, and you won't do anything with it. What I want to do tonight is have you guys leave here, be inspired, and actually want to take some action. I don't agree with speakers, and I was talking with a fellow earlier, that try sell you fractional ownership of a project, give you a certain amount of return, and they get all the profit. I'm here to sell you, just sell you on an idea more than anything, where you actually buy the property. You can touch it, see it, walk through it, it's yours. I'll be there every step of the way if you choose to use me and have me help you, whether it's property management, whether it's finding the property, analyzing the property, whatever it is, I'm there for you. Again, I'm here to inspire you to take some action. Investment real estate, it inspires me. I've been doing this now, this is my 19th year starting in March, and I think if I hadn't discovered investment real estate within my first couple of years, I wouldn't still be in real estate. Real estate can be super draining on you, but once you start investing in it and helping your clients invest in it, it becomes a lot of fun. You see growth, you see progress, and you really see almost a light at the end of the tunnel. A light that I didn't see my first couple of years in the business. All I saw was commission checks. After a couple of years in the business, seeing commission checks, I thought, Jesus, what if I stop working? I got no income. Nothing's coming in. And I looked at a lot of other realtors who didn't own investment real estate, who had no end plan, and they'd been in the business 20 years, and they were basically doing it until they're 80 years old, because they had nothing else. They had no end plan. They had nothing left. They needed the commission income. Commission income's fine, but I was looking for residual income. Now, I've been studying a lot, sorry about feedback. I've been studying a lot recently about environment. Now, when I talk about environment, I'm not talking about the earth. I'm talking about the people we hang around. I'm talking about hanging around people that inspire you and encourage you. There is so much negativity out there. You become like the closest 5 people you hang out with. So look who you're hanging out with. If they're the people you want to be like, continue. But if they're not, change your environment. If you're hanging out with negative people that don't support you and aren't helping you grow, change who you're hanging out with. You probably didn't think I was going to get into that. You probably thought I was going to come here and analyze properties. I'm encouraging you on different levels. I'd like you to hang out with people that are going to inspire you. I've been looking at the people that I hang out with. I don't know if I hang out with anyone that doesn't own investment real estate. Everybody I hang out with owns investment real estate. Now, whether I inspired them to buy investment real estate or, even hanging out with them pushes me forward more because I see them buying, and maybe they're at a different path than me, maybe they don't own as many properties as me, but I watch them buy all the way through and it inspires me. Most of my investors, and there's some in the room, know that when they buy a piece of investment real estate, I buy it right along with them. I own 4 or 5 properties that my clients own right beside. So I encourage you guys, when you leave here today, hopefully you're inspired. If you go to work tomorrow and you're talking to your coworkers and you say, I listened to Jason and he had some cool things to say about investment real estate and he had these great returns and he showed us how to do some stuff and I think I want to buy something. And they say, why would you buy now? The market's not good. What if interest rates go up? Vacancy rates are 10+%. Don't walk away from those people. Run. Those are not the people you want to be around. They want to bring you down to their level. There is so much jealousy out there. Has anyone ever heard rumors about me? The problem is, the more you try, the higher up the ladder you get, the more people like to pick at you. They don't like you one-upping them. And you're not one-upping them. You're just trying to improve yourself. You're trying to improve your situation. So watch the negative people, watch the naysayers, watch who you're hanging around. Kind of a stupid question, but who in here has ever thought about buying investment real estate? Obviously, everyone in here, that's why you're here. Who has ever wished they'd bought a property, and just imagine in your head, who's ever wished they'd bought a property, they'd look back and thought, I coulda, shoulda, woulda, if I'd only bought that property, look at what I'd have now. The problem with that is, back then, when that opportunity was there, you didn't seize it. Why? Because you couldn't see it. The problem with investment real estate, the day you look at an investment, it's not exciting. You know when it gets really exciting? I'm going to show you some slides later on, 10 years out, 15 years out. Then it gets real exciting. I'm going to show you a property I didn't buy. See what you think of that one. I bought it and sold it before I took possession. Who wishes they would have kept their first house? My first house was Country Club West, December of 1997, 159.9, 1,278 square feet, 3-bed, 2-bath, double-car garage. 159.9. The last lots that sold in Country Club were around 100,000 just for the lot. Do I wish I'd kept that one? I had a $1,200 payment on a 10-year mortgage. $1,200, 10-year mortgage. That was 19 years ago. The thing would have been paid for twice. I wish I'd kept every single property I'd sold. Now, I'll qualify that for 1 second. I've never sold an investment property. I will never sell an investment property. The only properties I've ever sold are properties that I own personally. That being said, God, I had a couple in Royal Oaks. Right when Royal Oaks started, people thought I was nuts. I built the third house in Royal Oaks. It was a snowfield, middle of the winter. I put up a 2,100 square foot house with a triple car garage, stucco, huge yard, landscaping, everything done. I sold that about 3 days after I moved into it for $240,000. I was looking online yesterday. There was an 800 square foot house in Countryside South for $240,000, no garage. I wish I had kept that house. Oops. Now, prices will come up. Things are on sale now. Do we know when they're going to come up? Nope. We had a staff meeting at Sutton the other day, and we were role-playing, and realtor says to me, he goes, well, you know, these clients are telling me, like, what if the market comes down still? What if we're not at the bottom? I don't know if we're at the bottom. Does anyone know if we're at the bottom? We've been dropping for about 18 months. We may be at the bottom, but we might not be. I said, well, when would you want to buy? He goes, right at the bottom. I said, well, I would too. But how do you know when the bottom is? You'll know when the bottom is when there is so much negativity and the economic conditions are so bad that absolutely no one wants to buy, and you're not going to buy. You know when you're going to buy? Is when it's come back up again. But even then you're not going to buy, because when the markets come back up again, you're going to go, ooh, what if it comes back down? Or it's going to come up and keep going, and you're going to think, oh, I missed it. There's always excuses, guys. I hear them all the time. They never end. You have to look at a property in the market we're in. We know it's on sale. Analyze it, which is the best time to analyze a property in a market like this, and act. The hard part is not finding the property. The hard part is having the fortitude to actually take action. Everyone in here probably owns the house they live in. That's not a hard decision. You've got to live somewhere anyway. You might as well make your own mortgage payment. I don't get that. I like investment real estate. I want someone else to make my mortgage payment. I don't want to make my mortgage payment. What's the fun in that? Now, we all know the real estate market's weakened. 2016 is going to provide us some amazing opportunities to invest in Grande Prairie. I've never seen in buyer sentiment this low other than one time. 18 years, one time I've seen it this bad. We all remember 2009, 2010. Who was buying then? Did anyone buy a house in 2009, 2010? Good for you. Did we know it was the bottom? No, it just made sense. How smart do we look now? I've bought houses all the way through. I bought houses at the top of 2007. I bought them 8, 9, 10, all the way through. You analyze a property conservatively, you take action. I'm going to show you some examples of some stupid investments I've made that, thank God, time made me look smart. Time is the equalizer with real estate. The time to take advantage of real estate, and people don't get this, and I'll share some stats with you why people don't get this. In the last 30 days, there's been 58 single-family home sales in Grande Prairie. That same time period in 2014, there was 128. So when are people thinking they should take advantage? 2014? Obviously, that's what they're looking at. But no, that's not when you buy. You buy when no one else is buying. That's when you get the good deals. That's when the sellers are stressed. You take advantage of the opportunity. And I'm going to go through, I'm going to talk about opportunity a lot here because one of the things I was blessed with, on top of finding something I was good at that I enjoyed, I've been able to take advantage of opportunities as I move along. I'm going to show you how to evaluate properties. And when I bought my first rental properties, I didn't have a clue how to evaluate properties. It wasn't until, I bought my first one in 2001. It wasn't until about 2009, 2010 that I knew how to evaluate an investment property. I had an investment seminar in 2009. I still didn't really know how to analyze them. Now I've got it dialed in. I know what I'm doing. I've learned a lot since 2009. The last time I did one of these similar was 2009. It was actually kind of funny. It was the first time I'd done any public speaking. And there was a guy that walked in with a dog, and not a little dog, but a big dog, and he was drunk. He could hardly stand, and every time I said something, he was like, I don't agree with you. And thank God his dog wandered out when he was passing out, and he had to go chase his dog. After the seminar, he was running around the parking lot looking for his dog. It was, how that happens to someone in their first public speaking engagement was funny. Now, 2009, I had this seminar, and I wanted to talk about, I just pick out 3 people from that seminar that really took what I said and did something with it. The first one was a buddy of mine. And this is going back in 2010. There was a condo development. And again, this is talking about taking advantage of opportunity as it comes up. Back in 2010, there was a lot of product. There was some multifamily. Builders were giving back money. Durham Homes was an example. They would give you $25,000 back, check in your hand when you bought one of their properties. I bought 2 duplexes off Durham Homes and I got a $50,000 check. Unreal. You can't do that anymore. That was an opportunity that came and went. Obviously, the banks cracked down on that. They said, you can't do this. That makes sense. Anyway, this particular developer I was working with had a lot of multifamily condos for sale. So I was talking to him one day and I said, you know what, they're offering, like $18,000 back on these, $180,000 purchase. Why don't you just put down 10%? You'll get your 10% back and you'll have no money in the deal. I said, you're not going to make any money on these because the rents are no good. I mean, we're in a recession. But I said, you'll break even. You got no money out of your pocket. Why not take advantage of the opportunity? So he listened to me, and he did. He rented out the one to one of his friends. The other one he rented out to his mother-in-law. Now, the nice thing about that particular investment, rents went up about $400 over the next 2-3 years. He started making money. He couldn't charge his mother-in-law any more money. So I would bug him every once in a while, and I'd say, hey, how's that rental going with your mother-in-law? I was talking to him about it last week, actually, because I was talking about investment real estate with him again. And it kind of hit me, and I said, how's that investment property with your mother-in-law? And he goes, yeah, I'm still losing money on that one. I said, you're not losing money, you're breaking even. He says, yeah, but I could get more. I said, she's been in there 6 years. I said, she's healthy. She'll probably be in there for another 19. She never misses rent. She doesn't party. She doesn't wreck anything. And I said, she is going to buy you a condo. She's buying you a condo. You have no money in the deal. If that thing never goes up 1 penny, she bought you a condo. If the value of it never goes up 19 years from now, you got $180,000. He goes, don't tell her that. And I know her because I used to go to school with her daughter. I had another client that came to my investment seminar in 2009. I'm giving these examples just because these people are no different than you guys. This guy, over the course of, him and his wife, over the course of about 2-3 years, bought 7 properties. He ran a gas plant south of town. 2 years ago, he took early retirement, the cash flow from the 7 properties he had, and he was done. He bought a place in Arizona. He spends 6 months in the winter down there, 6 months back here in the summer. He phoned me and told me and thanked me. He never would have been able to do that without that investment real estate. Now, how do you buy 7 properties? You need a lot of money today. Back when he was buying, it was 5% down. He didn't buy them all at 5% down because you'll find as you buy investment properties, it gets more challenging. I've been told no by probably every bank in the city at some point. You could buy investment real estate easier than I can now with less money down than I'd have to put down just because of that reason. So he had challenges. It wasn't easy to buy 7 properties, but he kept going, kept going. He had a vision. He knew what he wanted to create for a cash flow to complement his early retirement. I had another individual, and I talked to him last week, and I said, how many properties have you bought? And he goes, I don't know. And I said, I should probably know because I sold them to you. I said, I'm putting on this investment seminar. I'd like to know the number because I don't want to get up there and make something up and you think I'm lying. So he phoned me a couple days later. He goes, 13. This is a guy that was a mechanic at an oil field company. He was a head mechanic at an oil field company, but he was a mechanic at an oil field company. And there's nothing against that, but I'm telling you, this isn't a guy that was making huge money. But this was a guy that decided that he wanted to buy revenue property, and he didn't stop at 1. He didn't stop at 2, and he kept going. Now, he didn't buy and hold all these properties. He bought and hold the majority. He fixed and flipped some, and he did some rent-to-owns with other people's money. He didn't buy all these properties with his own money. You don't need to buy properties with your own money. 2006, I sold 31 properties to one investor from Edmonton. He only bought 2 himself. Everything else with other people's money. David Pelche and Jamie Soleil gave him $2 million. I was spending their money. It was kind of fun. So I'm telling you about those examples just because you might be thinking, well, how do I buy investment real estate? If you have the desire to do it, I'll sit down with you one-on-one and I'll figure out a way. There's always a way. Now, I'm going to tell you a quick story about where I came from. Lots of people don't know. Most people think I've been a realtor since birth. But I came from Valhalla. I went to school in Valhalla Center, and there were 6 people in my grade, including me. I went to junior high in Hythe, high school in Beaver Lodge. At the end of grade 11, I got a job bagging groceries at the Hythe Bigway. It wouldn't be bad if it was bagging groceries, but it was bagging groceries, cleaning the meat room, taking the garbage out, doing the garbage run, cleaning the floors, and literally you'd be cleaning the meat room with plastic gloves up to your elbows, and the girl at the front would ding you to come and bag groceries. You go up there, bag 2 bags, and then you have to go clean the meat room. $4.35 an hour. My next job at the end of high school, I was a lifeguard. I was making $6.80 an hour. Big improvement. It was at this point I was given an opportunity in Grand Prairie to come in and sell cell phones. 1994. They just opened a cell tower in Grand Prairie. And I'm going places with this, so just bear with me, guys. So I came in on a Monday. I sold a cell phone, and back then, TELUS would give you a $200 commission for activating a cell phone. We made 40%. I'd make $80. Then I'd sell you a case, I'd sell you an extra battery, I'd sell you a car charger, I'd sell you absolutely everything else I could sell you to go with that. By the time you walked out, I'd made about $150 in commission. It took me 2 days of solid work at the swimming pool to make what I could make in 15 minutes, half an hour. I learned the leverage of my time. So I was still scared. Commission income? So I'd work 12 hours Saturday, 12 hours Sunday at the pool. Then I'd work 5 days a week selling cell phones. I did that for the entire summer. At the end of the summer, they opened up a cell tower in Beaver Lodge, so I went back to Beaver Lodge. I was selling there. I went to university in Prince George. UNBC just opened. It was brand new. I took environmental chemistry and biotechnology. I had no idea what I wanted to do. I was selling cell phones while I was at university. I would drive back from Prince George to Beaver Lodge twice a month and sell cell phones. I'd sit on my phone in Prince George and I'd call people in Beaver Lodge and line up my appointments for the weekend. I'd come home, I'd sell cell phones all day, Mom would cook me supper, I'd go to bed, I'd do the same thing over, and then I'd drive back to Prince George. I did that for the entire first year of university. At the end of my first year of university, Peace River had opened up a cell tower. So I got in my vehicle, drove to Peace River, started a company, started selling cell phones in Peace River. It didn't go quite as well in Peace River because people were skeptical in Peace River for some reason. So I got a few other jobs. I worked at Paul's Sawmill in Planer. I worked at Village Sound in the evenings installing car stereos. And I was the dog catcher for Peace River. I had a pager. They would page me when a dog was loose. I'd phone a number. They'd give me an address. And I'd go track the dog down and put it in the back of my Camaro. Then I'd take it back to the SPCA. It paid good. I got $20 an hour for catching dogs. So after that, I went back for my second year of university. So my second year of university, I had the opportunity to sell satellite dishes. So I went in for an interview. I knew I liked sales, so I saw this ad for selling satellite dishes. So I went in, I met the guy, the owner, and there was all kinds of people bustling around this office. I went and sat down in his office, and he goes, do you know what a satellite dish is? I said, yep. Tell me about him, he goes. I go, I don't know, my parents had one. Here's 5 leads, he goes, go. And gave me a sales book. No training, no nothing. I had no clue what I was doing. I was sitting down in front of people. We had appointments every 2 hours. Thursday night, Friday night, all day Saturday, all day Sunday, I was selling satellite dishes. I did that for 8 months, my first 2 semesters, first and second semester, second year, sorry. At the end of my second year, everyone's broke. You guys have gone to school, you know at the end of your second semester, before summer starts, you're broke. I mean, you've spent all your money. If you haven't, you haven't had fun. I was going through the Auto Trader looking at Corvettes because I'd made that much money selling satellite dishes. It was hard work. This is no different. You think buying investment real estate is a get-rich-quick scheme? No. It's a lot of hard work. It's a lot of diligence. So I took what I learned and applied it here. So give me a couple more minutes on the satellite thing. I had the opportunity again when the manager I was working for said, hey, let's open an office in Grand Prairie. I said, sure. Now, if people give you an opportunity, say yes and figure out how to execute on it later. I said, yeah, let's do it. I was scared. I'm 19 years old. How am I going to run an office? I've just been selling these things. I can't hire people and train people. And he said, no, it'll be fine. We drive to Grand Prairie. We go rent an office right across from Audio Concepts. Next Level Fitness is in there now. We go to Staples, we buy all the office equipment, we hook up TELUS. He puts an ad in the Daily Herald and he said, salespeople will be calling you. And he drove back to Prince George. I hired 15 salespeople in the first 3 days. The phone just kept ringing. And I didn't know anything about hiring people, so if you came in and said you wanted to sell satellite dishes, I'd hire you. I'll train you. 3 days later, I put on my first sales training. 19 years old, I was the youngest guy there. I was scared out of my mind. I did that for 4 months. So still 19, 4 months in. At the end of 4 months, I ended up partnering with a guy out of Vancouver, started my own company, went back to Staples, bought all the office furniture again and leased my own space, did that for a year. It was at that point that I realized it's not all about the money, which is strange if you hear that coming out of my voice or out of my mouth. It's not all about the money. I was burnt out. I did that for a year and I was done. I walked in to a real estate office, McLeod Graham Realty, which is right behind Custom Cellular. Lauren McLeod, Michael Graham, I walked in there. I was still 19 years old and I said, guys, I got this company, I want to sell it. They said, okay. I sat down, I showed them what I had. They phoned me the next day and they bought it. So that was right before my 21st birthday. My 21st birthday came and I bought a house. I did what, any 20-year-old would do who has a lot of money and really no direction. I should have been buying real estate, but I didn't know back then. God, I could have assumed so many mortgages back then with that money, but no, I blew it. I bought a house. By this point, you guys all know I love cars. I had a Porsche Turbo. I bought a Mercedes because every 20-year-old needs a Mercedes. And I spent every last dime in about 60 days. After Christmas of that year, I'm sitting there and I go, I got like $7,000 left to my name. I've got no job. I've got no income. I got a mortgage payment. I got to pay this stuff called property taxes. I didn't know what to do. So I sat there for a while. It took me about a week to figure out, and I figured, the realtor that sold me this place, he looked like he had some fun. That didn't look that hard. He just went around and looked at houses. How fun is that? So I phoned the Real Estate Training Institute in Edmonton, booked myself in the next week, went to Edmonton, 15 days, boom, I'm a realtor. That was March of 1998. Then I got into selling real estate. I thought if I could sell 2 to 3 houses a month, I'd be set. 2 to 3 houses a month, decent income. Lucky for me, I sold more than 2 to 3 houses. It wasn't until my second year in real estate that I accidentally came across investment real estate. I think if I wouldn't have found that, as I mentioned before, I wouldn't still be selling real estate. It's my passion, it's what inspires me, it's what keeps me going. I like selling houses, don't get me wrong. Sell your house, sell you another one, first-time buyers, whatever the case is, it's okay. But my eyes light up when I talk about investment real estate. I'm going to show you the example of the first house I ever bought. And I'll go through, these are actual numbers. I took some time to analyze these properties and give you real numbers on what the returns would actually be. Now, we can complicate it with taxes and everything else. I didn't do that. If we want to get pessimistic, we can dumb it down with some taxes. I can show you ways to avoid some taxes. I can show you ways to make these numbers virtually work bang on. So here's my first property. Purchased in 2000. I bought it and sold it before the possession date. Why? Because I got scared. I made a bunch of excuses. $156,000. 4-bed, 3-bath, double-car garage. It was only 2 years old. I sold it for $160,000. You know how messed up my head was back then? I made a quick $4,000. I rationalized to myself I'd actually made $10,000 because it was going to cost me $6,000 to buy it, so I'd have $6,000 out of my bank account. This way, I kept the 6, I got 4, I was up 10. $6,000 to assume that mortgage. You can't do that anymore. We all wish we could, but when you could do it, no one was doing it. The opportunity was there and no one was taking it. Everyone looks at these opportunities now and goes, wow, I wish I'd done that. Now, let's look at some numbers on this. The average cash flow on that property would have been about $400 a month. Some months would have been high as $1,000. Some months would have been much less. But I was conservative at $400 a month. $400 a month isn't exciting. $72,000 gets exciting. The current value of that property, I'm being conservative. It's a Durham Caprice, 1,112 square feet, 4-level split, backing on a park. Today, $310,000, probably $320,000. I'm saying $310,000 conservatively, $154,000. I wouldn't have paid, sorry. A tenant would have paid $71,700 down on the mortgage. And I'd have 10 years left, and it would be paid for. I'll get into tax depreciation in a minute, but I would have got $27,840 back in taxes. $6,000. That would have been my financial situation. It wouldn't have all been in my pocket, but you see, it's all there. I walked away because $6,000, I'm going to make a few $100s a month. I don't know what I'm doing. I can't analyze the property. And honestly, that wasn't even a good investment property. It was an okay property, but it wasn't a great investment property. Even if you argue, and we just look at the rate of return based on the principal that got paid down, it's 1,200%. I don't know what rates of return you guys want or expect, but these are unreal. Now, I've got another example. Actually, before I get into another example, I want to talk to you guys about kind of one of the unique things about real estate is you make money 4 different ways. I don't know anything else you can invest in that you make money in 4 different ways. The first and the most important thing that I look for right now is cash flow. I want to know if I give $1 out, how quick that dollar is coming back to me. And everyone else should be the same. Am I going to get it back in 3 years, 4 years, 5 years, 10 years? How quick is it coming back? And I analyze every single property on a cash-on-cash return. You can get fancy cap rates and look at different things, but dumb it down, make it as simple as possible. That's the only way to look at it. Debt repayment. Obviously, you got a tenant in there. You're paying down the mortgage whether you want to or not. So you're gaining equity every single month through debt repayment. So even in a terrible economy and you have no cash flow, you're still making money on the tenant making the mortgage payment. I'm going to show you an example in a second how in a really bad economy and a really bad investment, you got to throw your own money in. Equity gain. I never buy a property to think that it's going to go up in price. If it goes up in price, great. But I buy a property based on what it's valued today, assuming 25 years from now it's the exact same property. I also buy it assuming that the rents are the exact same. Anything else beyond that is a positive. You analyze it today. Too many people go, oh, if I buy this, it's going to go up to here. Ooh, the market's going up. I'm going to get this rent and I'm going to get this rent. No. You can't analyze a property that way. The last one is depreciation. Now, I'm looking around, and the guy that I wanted to talk to about depreciation isn't here. So I'll have to phone him tomorrow because what I had to talk to him about was kind of important. Past client of mine. I just sold him his 4th property about 2-3 weeks ago. And he phoned me, and he said, hey, that thing at the Podolin at 8 o'clock, am I going to get anything out of that? I said, no, because it's at the Pomeroy at 7. Like, he's an old guy. He's a cute guy. And then I'm thinking, I'm going, well, this guy's bought 4 properties off me. He's probably not going to buy another one for a while. You know, is he really going to get anything out of this? And I asked him, I said, hey, do you depreciate your properties? No, what's that? I said, you should come then. So I know the properties he's got, and based on the properties he's got, he can write off $17,200 per year in depreciation. I know he's in a 40% tax bracket. He would get close to $7,000 a year back on his taxes for 25 years. I should probably call him tomorrow. Now, why depreciation? I'm going to give you a quick example. I've argued with accountants on this. I've got clients of mine I've had to convince to depreciate their properties. Let's take a $250,000 property. Let's just pretend the land value is $50,000 and we got $200,000. CRA will not let you depreciate land. They say it never goes down in value and valid. They say your house will be functionally obsolescent in 25 years, so they'll let you depreciate 4% per year. So if you take a $200,000 home, $50,000 land, you can depreciate $8,000 per year. Assume you're in a 40% tax bracket, and if you're not in a 40% tax bracket, NDP will have you in a 40% tax bracket before you know it. If you are in a 40% tax bracket, you're going to go to a 50% tax bracket. So assume a 40% tax bracket, $3,200 per year. After 25 years, you've got an $80,000 amount of money you've got back in taxes. Now, let's assume you never invested that money. Assume you put it under your mattress or wherever, put it in your closet, put it in a safe, but you never invested. You got $80,000. Now you sell that property, all of a sudden you have a $200,000 capital gain. Let's assume the property's never gone up in value. Capital gains is the cheapest tax you'll ever pay. You'll pay on half of the gain at whatever tax bracket you're in. So you got a $200,000 gain, paying tax on $100,000, 40%. You got a $40,000 tax bill 25 years from now. So I now have $210,000. I've got $80,000 in my closet. I got $290,000. That person that did not depreciate that property sells it for $250,000 and walks away with $250,000. You depreciate your property, you walk away with $290,000. It goes beyond that. $1 today is worth how much 25 years from now? Maybe 20 cents? Maybe 25 cents with inflation? You're pulling that money today and able to use it today as opposed to going, oh, I don't want to pay capital gains. I'd rather pay that $40,000 in capital gain 25 years from now. But I'll show you exit strategy in a little bit here. I don't want you to ever sell your rental properties. You should die owning the first rental property you ever had, and you should have at least a 50% mortgage on that property. I'll explain why. Not right now. I'll explain why in a minute. The misconception buying investment properties and what really stops people from taking action, they got to find the perfect property. What is the perfect property? I own all kinds of properties. I'm going to show you two examples of stuff that, well, should I have bought them? They wouldn't fit my criteria today. They presented an opportunity at the time and I bought them. You have to get over the perfect property. You have to look at a property as a return on investment. You look at a property, you set what you want for a return. Is it 15%, 20%, whatever it is, it doesn't matter. Find the properties that fit. Sometimes it's a condo. Sometimes it's side-side duplexes. Sometimes it's an up-down duplex. Sometimes it's a small single-family home that's a divorce or a transfer, and you get the opportunity to buy it. So there's no one property. I remember in 2007, Chelsea Villa condos were the best investment in Grand Prairie for your dollar. Now, well, 2008, you couldn't give them away. Now they've come back a bit. But I'll show you a couple examples. This happens to be a Chelsea Villa condo. And there was someone in the audience that was wondering how I was going to fit them into this, and I'll get to it in a second. I bought that condo. It was the first investment property I kept. Again, assumed the mortgage, $5,000 down. My rent back then was $1,100, $97 a month. Is there anything exciting about buying a property for $97 a month? Nothing. I mean, my cash flow today is $64. $2 a day in cash flow. My rent's gone up, it's fluctuated. Sometimes I've been $400 a month to the good. But the reason the cash flow's gone down, even though I've dropped my interest rate, condo fee's gone up. So is this a good investment? Maybe not really. But let's use the low of $64 a month over 15 years. Not a lot of cash flow. But the tenant paid $37,000 on the mortgage during that time frame. My current value has gone up $67,000. Now, I'm saying 170. There's nothing listed in Chelsea Villa for 170 right now. I think the cheapest is 189.9. So 170 is a fire sale. We were selling them in 07 for $225 to $235. It's an end unit too, so it's worth a little bit more. Taxes, $19,200 back, total of $134. There's some expenses I had in this one. I might have had more, but really, at these returns, does it really matter? I remember doing a dishwasher. I remember doing a hot water tank. I remember doing the hot water tank because it was the very first hot water tank I ever had to replace. And I only remember it being vacant 1 month. It might have been more, but look at the return on that. That's on a property, the cash flow is $64 a month. In 10 years, that thing's paid for. In 10 years, I'm going to make another $61,000 in equity on that property just from the tenant paying it off. Am I ever going to do that? No, I'll probably let it ride another 2, 3, 4 years and do an equity takeout. I'll get into why you do that later. So those are a couple examples of probably my worst investments. Oh no, I got one more. This one's actually even worse. I bought this property. Now, who the heck would ever pay $430,000 for a single family home to put a family in? That's the worst rental property you can buy. But I had the opportunity to buy it with $15,000, which wasn't a huge amount of money. Rented out for $2,500 a month, I was break even. I didn't make a cent on this property. 2009, 2010 rolled around. I was $500 upside down. But I was paying $700 down on the principal. So I was basically paying $500 to the bank. My tenants were paying the interest, taxes, insurance, and $200 down on the principal. So it'd be like you going to the bank and saying, hey, I'll put $500 in and the bank throws in $200. I'd do that every single month. So this is an example of an upside down property that I'm subsidizing. And it's still paying me $200 a month. But it actually wasn't, because I was depreciating it. And at the end of the year, I get $6,080 back on my taxes. So after all was said and done, I was break even and gaining $700 a month. Today, this property, I checked it on my database, rented out for $2,800 a month. My property manager's in here, so I can't lie. $496 a month, $1,080 is going down on the principal now, still getting the same back for taxes, netting close to $2,000 a month. I owe $344 on that place now. $24,000 cash flow, $48,000 back in taxes, $58,000 the tenants have paid down in principal. This property has not gone up 1 penny. I paid $430, it probably dropped to $380. It came back up to about $450, and now it's sitting at about $430. It might even be $420 at the moment, somewhere in that range. It's a nice house. It's an O'Brien. It's 1,800 square foot, 4-bed, 4-bath, Brazilian hardwood, walkout basement. It's a nice house. Is it a good rental property? It is now. But in 2010, it sure wasn't. If I sold you a property that you had to fork out $500 out of your pocket every month just to subsidize it, I'd hope you'd be in my office having a conversation with me. Why is now a good time to buy? Property is on sale. We know that. Money is on sale. Interest rates, they've never been this low. You lock in for a 5-year term today, does anyone guess at how much money would go down on your principal on your very first payment? 51% of your very first payment goes down on your principal. Doesn't matter how much you finance, it's linear, 51%. By the time you make your 60th payment of your first 5-year term, 58% goes down on your principal. That's never happened before. That makes a huge opportunity. Now you argue, what if interest rates go up? Who gives a damn? 5 years from now, sell the thing then. If you don't like it, get rid of it. Your tenants have paid down a ton of money in the meantime. You've got the cash flow from it because we analyzed it, figured it out in advance. So walk away. Take your cash flow, take your depreciation, and take your equity that got built up in it. Now, the neat thing about a market like this, we get blinded in a boom time. In a market like this, we analyze properties very, very carefully. It's the best time to buy real estate. It's hard to find a property that will deliver the returns you want now, which means you have to look at a lot of properties. You might have to look at 20, 30, 40 properties. You might have to spend months looking at properties before you find the right one. In 2006 and 2014, you could blindfold yourself and just go pick one. Then you pick the rent, someone would pay it. I had a builder from Prince George, building in West Point, sold him a house in Patterson. He drywalled his shed and was getting $800 a month for his shed. He thought it was funny. I thought it was funny too. Vacancy rates now are a lot higher than they were. Apartments are touching 10% for vacancy. Nothing wrong with that. You have to analyze where rents are at and make sure you can rent out your property for less than what the going rate is. Then you know you're full. Would you buy an apartment-style condo right now? No. Apartments are 10% vacancy. You would have to undercut so much there would be zero cash flow in an apartment-style condo at the moment. You would have to buy it so cheap that I don't think you'd be able to buy it as cheap as you'd need to right now. But you can look at them, you can analyze them. You've got to look at the market and where the market's at. One of the things we need to look at is removing the risk in the acquisition. So it doesn't have to be me. Anyone that has the experience, qualification, the abilities. The only thing is if it's not me, if it's anyone else, make sure you ask them, how many properties do you own? If you're trying to sell me a duplex and you own a house and you only own one property, maybe I'll get a second opinion. You have to ask some of these realtors the tough questions. And if you're going to go out and look for a house by yourself, that's fine too, but you have to do a lot of research. Cutting edge technology, well really, Jesus, if you've got a cell phone, you can download apps for cutting edge technology. Find someone who will not hesitate to buy the same properties you're buying. If I'm showing you a property, I can almost guarantee I own it, or something very similar, or I'm probably buying it right along with you. And I don't say that, I can show you. Some of my clients in this room have been in my office and I'll show them my rental database. When we'll scroll through and I'll be like, they'll say, what's the rent on that property? I say, boom, it's right there. I own one. Now, analyzing properties, I'll touch on it briefly, but let's pretend we're looking at a $100,000 house and you want a 20% rate of return. You're going to need $4,000 back per year, positive cash flow. And that's a rough number because we're saying you're not reinvesting it, so we'll just use 5 years. So $4,000 per month, $4,000 per year, $333 per month. So let's go backwards. What's the mortgage payment on a $100,000 house? $20,000 down, $80,000. The mortgage payment works out to be $367. Let's add taxes. I just used a number of $150. I added $50 for insurance. And then I added the $333 back for the positive cash flow I needed for the 20% return. That gives me a rent amount of $900 a month. I thought it was kind of cool it came out at $900. I didn't mean for that to happen, but it came out at $900. So if you're looking at that $100,000 property and you go, yeah, I can rent that out for $1,000 all day long, you've got something. If you look at that property and go, damn, I can't get more than $700 for that place, where are you going to come up with the other $200? There's only one place. You have to buy it for less to drop the mortgage payment down enough so that you can cash flow where you want to be. So you get the idea. You can work that backwards and forwards on any property. You can get your realtor to do it for you, or you can just download a mortgage app and figure out how to calculate your mortgage payments. It's super simple. I can show you on one-on-one meetings if you guys want and show you how easy it is. You need to figure out the return. You need to figure out what's acceptable for you. Do you want a 20% return? Okay, of course we all do. It's not easy to get a 20% return in this market. It just isn't. Would you be happy with a 15% return? And when I'm talking about those returns, I'm not even talking about the fact that it might go up. That's not why we bought it. The tenant's paying the thing down. That's just a bonus. The depreciation, well, that's just a bonus as well. I'm talking just based on cash flow. That's how I'm analyzing it. If you factor everything else in there, this becomes too easy. So I just look for the cash flow. Now, real estate versus stocks, remember I was talking about leveraging my time. Well, talk about leveraging money. You know why those returns were so high on those examples I showed you, the properties that weren't really great? I didn't put much money in. The more leverage you've got, the better your returns are. You have to be careful as you over leverage, as you see. Sometimes you have to put money out of your pocket every month to make the investment work. 100,000, 20% down, goes up to 135. You got 175% return on your money. You go the other way, all cash, you got 35%. You have to put other people's money to work for you. Look at stocks. Look at mutual funds. Your leverage is 1-to-1. There's no leverage. You buy investment real estate with 20% down, your leverage is 5-to-1. You got your 20% unit, and you got 80%, 4 other units equal. And when the market doubles, you go to 10 times. You buy a stock, you buy a mutual fund, it doubles, you make 2 times. You need the power of leverage. The neat thing about it, obviously, is those 4 borrowed units that you got some random person paying them off for you continuously. I've got an example. Well, talk about this real quick. Banks will not give you money to go buy stocks. They will give you up to 95% of the value of a house. Why? Because it's that much more secure. I want to give you an example of kind of a stupid investment that I made back in the day. I had one of my clients come to me. Anyone in here heard of DBG Games? DBG Games, in its infancy years ago, was a company out of Seattle. One of my clients came to me. He was a nice guy. He was raising capital for this company. And he came to me and he said, Jason, give me $25,000 and I'll give you $30,000 in 6 months. I was hesitant. I didn't really want to give him the money, and he kept bugging me and phoning me, and finally I said, sure. Give him the $25,000 US. 6 months later, he said, I got your $30,000 for you. He goes, do you want to maybe put in $100,000 and we'll pay you 12% interest? I had the money sitting in the bank. I thought, okay, why not? I'm getting like 1% in the bank. So I gave him $100,000 US. and he'd show up at my office on the first of every month and give me $1,000 US every single month. Discovery Bay Games was making board games back then, and they were pretty cool. I'd go camping, I'd take these board games, and you'd play them, they were kind of neat, and when you've got money invested in the company, you think it's really cool. So after about a year, I said, well, how about I give you another $100,000? Give him another $100,000. He shows up at my office every month, $2,000 check. Then things started to get really cool. We started to get licensing for Dora, Sesame Street, Saturday Night Live, Atari. This is all really cool stuff. I mean, you could take your iPad. We had license for the Atari, and we had like a joystick thing. You stuck your iPad in. I thought this was cool. I'd go down to Phoenix. You went into Target. You went into Walmart. You went into Toys R Us. They were actually selling this stuff. I thought this is going to go through the roof. He asked for another amount of money. I ended up, at the end of the day, I was in for $458,000. Grand Prairie as a whole was into it for over $18 million. Grand Prairie basically financed this company. And the worst part was, I knew everyone else in the game. And they were all business owners, well-respected. The problem was, no one was doing their due diligence. Because everyone knew who everyone else was in the deal, we all just assumed it was good. All of a sudden, there was no more interest payments. Logitech comes in. Anyone know who Logitech is? Logitech comes in. I'm thinking, we got this tech stuff. I actually digress for a second. I actually have a board game, a trivia board game of Saturday Night Live. It's still in the plastic. So we had legitimate stuff. So Logitech comes in, and they offer $10 million. Now, they had debt on the books, so Logitech couldn't put the money in, because if Logitech put the money in, all the promissory notes would have to get paid out. So we had to convert all of our debt to equity. We had to convert all of our debt to shares. We had no option at that point. Logitech was a good thing. They put in $10 million. We got a bunch of shares. I don't know exactly how many months later. It was about 4 or 5 months later. Logitech had gone through about another $7 million. They had $3 million left. They pulled the pin, walked away, and we had zero. $458,000 gone like that. If I would have put that money in real estate, you can't take my real estate away. It might go down in value, but you can't take it away. I can touch it, see it, feel it, smell it, walk through it. It's mine. I run about 50% expenses in my business, so it takes $1 million to make that $458,000. It was a huge waste of a large part of my life. Even worse, so the next year on taxes, I think, well, I got this $458,000 loss. My accountant goes, well, that's actually a capital loss, he said. So you can only use it against a capital gain. I'm never going to sell my investment property. I don't have capital gains. It's useless. It was gone. I got over it. But what I learned is to invest in real estate. I will park money in stable money market, mutual funds, bond funds, stuff for short term, but there's no leverage in it. I park it there while I'm looking for real estate investments. Talk about quick flip properties. You have the opportunity to make great profit. The problem with quick flip properties, too many people watch Flipping Vegas. They're looking for a home run. There's no home runs. In reality, if you can make $10,000, $15,000, $20,000 flipping a property, take it and run. It might take you 3 months to make $15,000, but what if you did 3 a year and you made an extra $45,000? That's capital gains. It's the cheapest tax you'll ever pay. Enables you cash for long-term real estate investments. Most people, though, will make their money and take it, and Grand Prairie's terrible for it. They'll take it and they'll spend it. So you have to be a little bit disciplined. The disadvantages as well, they're really hard to find. You have to be ultra careful, ultra conservative. It will always cost you more money than you think, and it will take you longer than you think. You have to factor that in there. So what I like instead, and we can still do fix and flips. I still got clients that do it. I'm just ultra careful with it because you're going to come back to me to sell the thing. And if you don't make any money and I make the money, you're going to be pissed. You just spent 90 days renovating a house and I make all the money. You're never going to do it again. So I have to make sure you're making money at it. Better alternative, what if you could buy a house for $300,000? And I've seen people do this, so before you call me a liar, put $20,000 in, get an appraisal for $400,000. You pull $80,000 out, you've got all your money out of the deal. You move on and you go do the next one. A lot of the people doing up-down, not up-down duplexes, but suited units in 2013 into 2014 were making $70,000, $80,000 per unit. The problem was, and what they didn't get, is they would take that money and they'd make that money. And I think if I talk to those realtors today, hey, do you know where that money is? They don't know. I told them, I said, don't sell the property, refinance the property, take your cash and do the next one. Because at the end, you've got a bunch of assets. Your bank account's not as big, but you've got a bunch of assets that didn't cost you any money. I'll give you an example that I happened into. This is one of my better investments, but completely accidental. There was an industrial piece of land on 92nd Street, 1.5 acres. I bought it in 2002, I think, 2003. It was like $100,000 for an acre and a half of serviced industrial land. I didn't know how good a deal it was. I just bought it. I didn't know what to do with it. I thought, well, maybe I'll subdivide it. So I subdivided it, and then I thought, I know if I turn it into a bare land condo, I can put a building on and finance it separate to the next one. So I put it into a bare land condo, and I put up a shop. I leased the shop out. I went to the Alberta Treasury Branch with an appraisal in hand, a lease in hand, and they gave me 70 cents on the dollar. 70 cents on the dollar took all of my money out of the equation and actually put money in my pocket. I did the next one, and the next one, and the next one. I walked away from that investment with a profit and 100% financed. Now, that only makes sense if I have a lease in hand and I go to the bank and I know I can get 70% and I'm still making money. I own that property today. I've owned it for about 13, 14 years now. That particular property today makes me close to $6,000 a month after all expenses. And I have zero money in that deal. It was an opportunity. Do those come along very often? No. You have to have your eyes open and you have to be prepared to act. Talk about different types of property. I've focused a lot on residential. That was just a quick commercial one. The nice thing about commercial real estate, be it retail or industrial, is the tenants pay all the expenses. In residential, you're covering everything. As soon as you get into commercial or retail, they pay snow removal, they pay lawn care, they pay depreciation on HVAC units, they pay your insurance on the property. Any expense on that property, they're paying. I got a strip mall in Crystal Lake. Someone drove through the strip mall and drove out with the ATM. Tenant pays. I don't pay. It would have been insurance anyway, but if it happens on residential, you're paying. Now, the risk involved with industrial and retail is a lot higher. How would you guys feel if you owned an industrial shop in Grand Prairie right now? Be nervous. The thing about industrial is if it's vacant, You can drop the rent to 0 and you might not fill it. If there's no company to go in there, it'll sit vacant for a long, long time. Blockbusters, for an example. Blockbuster by Safeway, it's a good location. It's been vacant since Blockbuster closed down. State and Main just finally opened in the other one. How many years has that been? 8 years? 6 years? I'd hate to own that property. That being said, the property below Sutton, vacant for 5 years. I was lucky that, I'll tell you how that's structured, but you can be in a real bad position with retail and industrial property. So you have to be super careful. Even if you've got really good leases in place, can you imagine if you bought a property that Blockbuster was in? You'd think you'd be golden, gone. There's been 2 or 3 industrial oil companies in Grande Prairie, Beaver Drilling, Compass Compression, disappear. Those properties are now vacant, which is why I like residential real estate. It's so simple and it's easy to get into, and if you adjust the rates, you can always rent it out. The lower level of Sutton, I was offering free rent for the first year, and it sat vacant for 5 years. You could move in there, you didn't have to pay anything. You just paid the common area cost. You just paid the taxes, that was it. And I still couldn't rent the space. I'll give you an example, though, of the opportunity in commercial real estate. This is another example of someone gives you an opportunity, you don't know how you're going to do it, take it. Fellow came to me back in 2003. He was friends with the owner of Sutton. And he sat down with me and he said, Jason, there's 6 acres in Royal Oaks. If you want to, I'll partner with you on it. So again, this doesn't always have to be your money. You can find great strategic partners to invest with. He said, I said, well, how much is it going to be? He said, $162,000. That happened to be pretty much the exact amount in my general account. So if you give me an excuse as, you know what, I've got the money to do the deal, but it's all the money I've got, I really don't want to tap myself, give it a rest. I've been there. I tapped myself. It was all the money I had. It was worse than that because once I put my money in, we had a $40,000 tax bill the first year. And we had a loan payment to make. And this guy's in Calgary. He's got more money than he knows what to do with, and I'm sitting there going, holy shit, what am I going to do? I went back to what I knew. I found a surveyor. I chopped up the 6 acres. He didn't even know what I was doing. He just let me go. I sold the front acre to Joey's Only for $500,000. That relieved a ton of pressure on the loan. I sold the second acre a year later for $500,000. That eliminated the loan and put money in her pocket. We were then able to build an 18,000 square foot strip mall without putting $1 out of our pocket. I'm still 162 in. That's it. Then we sold the back 1.4 acres for $575,000. Now it's really lucrative. Then I built the next building on there, still did not put any money in. That project now is worth $4.2 million, and I came up with $162,000. I'm not in any way, shape, or form trying to brag or boast to you. I was presented with an opportunity that made my ass pucker. It was every dollar I had, but I took advantage of that opportunity. Could I have failed? Sure. But I just keep trying. So that's what I'm trying to instill in you guys, that you have to take these opportunities. What I'm here to share with you, though, is I'll help you analyze these opportunities. I didn't have anyone. No one taught me how to do this. I taught all on my own. Really, that opportunity there, the only reason I went in because I knew he had a lot of money. Worst came to worst, he probably would have covered me for a little bit. But you have to take advantage of those opportunities. I will show you how to analyze a property because I don't want to see any one of you fail. That's the last thing I want. If you need help, I sell you a property and you can't find a tenant, you're getting trouble from the bank on renewing a mortgage. I don't care what it is. You've got a tenant in there that won't move out. They haven't paid rent. I don't care what it is. I've been through every possible situation. I will help you out. Speaking of every possible situation, rentals don't always go well. I've had SWAT go in 2 houses, and SWAT's like TV. When SWAT goes in, they don't just kick the door open. They hit that door so hard, all 3 hinges pop off and both door jambs go off and the thing's sitting on the stairs. They don't open your kitchen cabinets to search them. They just rip them off the hinges. They tear the tenant's stuff apart with big knives through all of their furniture looking for whatever they're looking for. When you get a call that SWAT's been in your house, it's not a good feeling. The only good thing about SWAT going in your house, they've taken your tenants and put them in jail. It's a true story. You have about 24 hours to secure that property. And I forgot to tell you about flash bombs. They use flash bombs. That ruins siding. That stops them from running out the back deck. It also ruins your deck. They're in jail for 24 hours. This one particular one, it was in Summerside South. It was a nice house. And we got there, secured the door, secured the back door, fixed the garage door, and basically got it locked up. Put a note on the door saying, if you want access, call us. The neighbors are watching. If you try get in this property, we're calling the cops. These people did not want to be involved with the cops anymore. I got all the money for the repairs on that one deal. And then some. I actually made money by SWAT coming in there. And I make it sound worse than it is. The siding repair was about $700, $800. The door was $1,500. A couple cabinet doors, another $400 or $500. Hauling all their stuff to the dump was a few $100s. I think all in was about $3,500. I got $4,000 from them, plus they'd paid me the full month's rent, plus I got their security deposit. It took me about 2 weeks to get the property right again and re-rent it. How about people burning your houses down? Happened twice. One was partial, one was a full. The full burn was about 3 years ago. I was driving into Whistler. I get a call from James Kostiak, who actually used to rent a room for me years ago. He said, Jason, there's been a fire. I'm like, oh, shit. He goes, it's one of your rental properties. I'm like, oh, good. I phoned Shondell at the time. I said, you deal with it. I don't want anything to do with it. I never even drove by the house. I didn't want to see it. I phoned up the builder. She dealt with insurance. They paid the rent for the entire year, and I got a brand new house. Your insurance, if you check, mine anyway, goes up 10%. The first year, 5% the next, then back to 0 on one property. So we're talking like $60, then $30, and a brand new house. I was pissed off because I had to pay the deductible. I held the security deposit back to try and get the deductible, but because it was arson and it wasn't the tenant's fault, I actually had to pay him the security deposit back. So I'll teach you how to handle problems like that. Any problem you could possibly have with a rental property, I've probably had it. Landlord-Tenant Act. If you don't want to memorize it, we know it. We know your rights. We know the tenant's rights. More importantly, in Grande Prairie, we know the gray area. Because tenants have too many rights in Grande Prairie. And the black and white of the Landlord-Tenant Act, there's ways that you can make tenants' life miserable, and I'll teach you the tricks of the trade. Sometimes you need to get them out, period. Now, financing. You've seen some of the examples I've had on financing. Looks pretty easy. Assume a mortgage, anyone can do that. Anyone in here has probably got $5,000. You could assume a mortgage tomorrow if they were still available. They're not. 20% down on rental properties. The last time I did this seminar, in 2009, it was 5%. It was easy. In 2007, it was 0. CMHC would insure 4 properties with 0 down. The neat thing about now, though, it's a little harder to get into a rental property. There's less competition. When you've got every Tom, Dick, and Harry buying rental properties with 0 down, you've got all kinds of competition. Now, there's a few ways around it. CMHC says you have to live in the property that you're putting 5% down on. So maybe you want to move out of the property you're in, rent it out, and buy the next one with 5% down. That's an easy way. And honestly, you can keep doing that as many times as you want. What if you've got a brother, a sister, any family member works to put them on title and do 5% down? I've got one of my clients that's got 2 sons. They're both teenagers. He owns an up-down duplex with both of them. I had another client of mine just do one with his brother at 5% down. Does his brother live in the property? I don't know. It's not my job to go check. Does this guy's 2 sons live in the up-down duplexes with 5%? They are supposed to. If he has a moral dilemma, let them live in there for 3 months and move out. If you want to buy a piece of investment real estate at 5%, you don't want to move out of your personal house, go live in it for a few months. You satisfied what you did at the lawyer's office, which signed an affidavit saying you're going to live in it. Morally, it's up to you. It's just one option. Talk about exit strategies. Go back to that for a second, sorry. If you guys have a will to buy some investment real estate, and I hope you do, fill out the forms you've got. I'll phone you, we'll sit down, and we'll figure out a way to do it. And if we can't do it today, we'll figure out a plan to do it very soon. Exit strategy. I'm almost done here, guys. Exit strategy. You never want to sell your real estate. For example, that Chelsea Villa condo. In about 3-4 years, I'm going to owe somewhere around $35,000 on that property. I'll pull out $100,000. It's tax-free money. It's borrowed money. I reset the amortization. The tenants pay the thing down again. If you want, you could pay the thing down to 0, pull out 80%, put another tenant in for a 25-year. I can talk to you in depth later, but there comes a certain point from a tax perspective that you want to keep a mortgage on the property. That last payment on the very last day of that 25-year mortgage is 100% principal. It's taxable. So you always want to have an interest component in there. You always want to have an interest component. You always want your tenant paying it down. And the idea is to keep pulling money out tax-free. If you have an RSP, it's 100% taxable. Your rental property is like a bank machine. You can go back to it as many times as you want and pull money out, and you pay no tax. There's no other thing out there where you can go and dip in, pull out, and pay no tax. Everyone in here probably has RSPs. You think they're exciting, you watch them grow. Wait till you're 65 and you got to pay tax on them. You got 100,000, 200,000? No, you don't. You've got percentages of that. What do you think the government is relying on 20 years from now? They're relying on us investing in our RSPs so they can take it. Now, I read this the other day. 83% of Canadians at 65 are broke. 83%. No, I didn't read further to figure out what broke was because I don't care. I just don't want to be that. I don't want anyone in here to be that. Be the 17%. I honestly don't know how you're going to get there, though, unless you own investment real estate. What else are you investing in? You can invest in companies, just not DBG Games. But I mean, you can do that. I don't know how to do that. I proved I don't know how to do that. It's not my business. I invest in real estate. It's so simple. It's so easy. You can invest in RSPs. That's not going to help you retire. Take your RSP money, invest it in real estate. I'm not saying cash out all your RSPs, but definitely give it some thought. It's a better place. I could sit down and look at your RSPs, figure out how much you've made in the last 5 years, show you how buying a real estate investment would have made more sense. You decide. It's up to you. When I started, remember, we'll go right back to my $4.35 an hour. I never knew where I would end up. The fun part about where I'm at now is I know where I'm going. Even if I don't sell another house, buy another investment house, I've got enough investment properties that they're just paying themselves off every single month. It gets exciting. Shondell and I the other day just updated my database, and we got to, and some of them we hadn't updated in a couple of years, figure out the balance is owing. And the equity growth from the amounts paid down was a large number. It was pretty exciting. So I started with one. I started with the Chelsea Villa condo. It was a $100,000 property. And I just kept buying. And buying and buying. What if you buy one? If you can buy one, you can buy two. You just have to make a decision. It might take you a couple years. Set a goal, figure out where it is. If you need, and sit down with me, I'll show you how to do it. We'll figure out what you have to save up and how you're going to go about doing it. The individual that bought the 13 properties that I was telling you about from the last seminar, I said, when was the last time you bought one? He said, about 3 years ago. I said, smarten up. You bought 13 in like 3 years, and in the last 3 years you bought nothing. He goes, well, I was focused on other things. Smarten up. When you're focused on real estate, you could do it, and now you haven't. So I guarantee he's going to start buying real estate in the next 12 months. Guys, I was serious earlier on talking about your environment. Surround yourself with people that are going to empower you, that have the same mindset as you. Really watch that, because I want each and every one of you to be successful. I really do. That's what I have fun doing. Yes, I make a commission if I sell you a property, but really what I'm getting out of it is self-satisfaction. I like watching people succeed. It's fun for me. That's what juices me, and that's what keeps me going. So, guys, if you can, fill out the white sheets if you want. I can be in contact with any one of you. I have one more favor to ask. If you liked what I had to say, go on to Twitter, Instagram, Facebook, write me a note, pump it up, and I want to thank everyone for coming. Hope you have a great night.